I've lost over $2 million in bad operators. I say it's never a bad investment. It's a bad operator. You're giving the money to a jockey. Is the jockey willing to die on the horse?
Are there any must asks when you're evaluating these operators?
Numbers never lie, but I can make them say whatever I want.
What part of passive investing do you think needs to die?
I think one thing that needs to die is
the views expressed in this podcast are those of the individual guests and do not reflect the opinions or recommendations of Invest Clearly. This podcast is for informational purposes only and should not be considered investment advice. The appearance of a sponsor or investor on this show does not constitute an endorsement or a warning. Invest Clearly is an objective and neutral platform. Always do your own due diligence before making any investment decisions. All right, Daniel, thank you very much for joining me. I've been really excited to have you on. Before we get started, like I said before, you have a really awesome background. I'd love for you to introduce yourself, and then we can jump right into it.
Yeah, Pat, man, it's good to be on, man. Well, I've been investing in real estate for 20 plus years. I'm in the real estate space, so I actually operate a real estate team in California. We've been the number one medium and large size team in California for literally probably 10 years. Very high in systems. For me, it's high it was high in income generation. So it's figuring out what to do with that income is kind of why we're having this conversation. But I started investing in real estate when I was about my first home at 22, built my own portfolio, started investing in syndications and in other people's funds in about 2003. But I'm a father of 3 kids, been married for 18 years, and my whole world really revolves around some facets of real estate. I've also been part of this tribe called GoBundance, which it's been part of my life for 11 years now. I actually serve on the executive board, and I'm a host of a show called 728, where we're talking to a lot of investors, just a lot of people, finding their journey from 7 figures, which is $1 million, to 8 figures, which is 10 million. And what we find is a lot of the GoBundance guys that are in the space, and this is why people are investing in other deals, so why they're investing in active and also horizontal income and or businesses, is you're trying to figure out what the best route for you is to build to 8 figures. And what we notice with a lot of people that we talk to that are worth $2, $3, $4 million is they have this look at desperation. And they're like, man, I thought when I became a millionaire, everything would be easier.
Yeah.
But it's actually more challenging. So our show talks about those challenges. And in the route to 8 figures, which is 10 million, you start defying gravity, start getting more help, start investing in other things. And then your passive income, or I would say your horizontal income, starts defying gravity a little bit. So that's been a really fun project. We've been doing that, I think, going on 6 years now.
That's awesome.
So we've interviewed probably 5 billion in net worth in that one, including Richard Branson, which was really cool.
Yeah. I'm very familiar with GoBundance. I've gotten to know Matt King really well. I'm pretty sure I've been on one of your calls when I was evaluating. I've gone up to a meetup in Boston that they had locally. It's awesome program. What you guys do there is awesome. So I would love to understand your background. You're active in your real estate business out in California. You've got the brokerage team. And I believe I read in the background, you've also run about 5 other businesses. What led you on the journey from active operations into passive syndications?
Well, I think there has to be an involvement. Like for me, why don't I just take you to the beginning part where I was buying single family homes myself. And honestly, you got A class, B, C class, and then I have D class, which is dog shit. Like the stuff that is going to be a great return. You're like, man, this pencil's awesome. Home is 100 years old. Cash flow is going to be great. And you're buying a lot of these. And then every time you get your P&L, you're like, what? Why am I not making any money on these things? Because an AC is breaking, plumbing, roof issues, a tenant walks out, eviction. And so I started my journey at buying real estate the hard way. And I started learning, okay, what's the difference between D, the dog shit stuff, compared to C and B class. And as I was building my real estate portfolio, I've had about 80 California doors. I realized it took a lot of work, right? So wasn't passive income. It was active, right? Yeah. So I was actively kind of managing some of these things. And I'm like, I kept trying to figure out how to get better returns. And the better returns I got, the more lift it came with. So then I'm like, you know what would it be if I focused that time in my business? And this is like 2013, so it's like 12 years ago. And my business was taking off and it's demanding time, and my real estate was taking off and it was demanding time. I was renovating properties, putting them on the rental market, doing all these things. And so um as that list started getting heavy, I'm like, man, what would it look like if I just spent all my time in my business? And then what I did is I diversified by giving and allowing other people to steward some of my money, which gave me my time back. So, and I knew it was going to be not forever, right? I'm like, look, this is something that I need to do because it's a bigger, best return on my time building my business. And I'm going to have to surf others' wakes, and focus on other people's skill set, and release control of my money. But it will allow me to kind of dive into real estate in my business and build it. And so when I did that, I sold half my California real estate.
Oh,
And
wow.
instead of buying other larger properties that I would have to operate, and I bought a couple, and I noticed the heavy lift of a 12 unit that you're renovating. Um, then I'm like, you know what? I'm going to start investing in other people's things, bigger, larger deals that I thought were great returns, that were great returns. That I'm like, well, I don't have the 2 million to put down or 3 million to put down, but between a pool of people, and a great operator, I could ride in others' waves, and I'd rather be part of, instead of having 100% of a okay deal or a good deal, I'd rather have a 10% or 5% of a great deal, and a good operator. And so that's kind of where my journey started in actually releasing control of my money in 2013. And I've been able to see things go full circle. 2018, 2019, we had some exits on some of those, and we kept adding positions to those general partners. But my initial start in real estate wasn't just right into syndication. Like,
Sure.
I went in and I was operating real estate myself. So I got to learn a little bit of what underwriting looks like. What are the things that you don't underwrite, like an economic vacancy, right? I've experienced that before because I'm like, yeah, the properties are 100% occupied, but only, 95% of the tenants are paying,
Yeah.
right? So you got 5% economic vacancy, even though it's 100% occupied, right? So little things like that that you kind of figure out yourself, that you're able to see in other people's, operating agreements, or the PPMs that they're putting together. And then you're able to kind of dive in a little more into their underwriting. But that was my journey into the syndication space. It didn't start right away, and for me, it was a stewardship of it. No, yeah, okay, I've invested a ton of money in other people's deals. I've learned a lot of lessons. I've lost a lot of money in that, in some of those operators. Um, so I learned a few lessons from there. Like, if you're going to release control of your money and you're going to allow somebody else to steward your money, you have to diversify that risk, right? So I have a rule where I don't give more than 10%. I don't allow any operator more than 10% of control of my net worth. And when I do that, even with that operator, I'll have two, three, four different properties that we're investing in them, or say funds. So if something were to happen, like you're seeing some of the things that are happening now, where
Hmm.
one operator goes down, you find out that something happens, they didn't underwrite something right, or just straight fraud, it's not going to take away your full net worth. Yeah, okay, it's going to sting. Maybe it's going to, but the max it's going to affect you is 10% of your net
10%.
worth. Those are some of the rules that I put in place for me as I was releasing control of my money. I wanted to diversify that risk. And then some of those operators, I made sure that there were different asset classes, like
Sure.
industrial, storage, some apartment buildings, or whatever other asset class that we would have, even have some industrial triple net that's not doing the greatest, but it's an investor that knew that space. And then we got in there, and I'm glad that I didn't give them more than 10%, because the returns were fantastic, but then nobody expected the rates to go up like the way they are. Now they're
Yeah.
struggling to make debt. Now they're selling certain assets to create liquidity. The fund's going to be okay, but the 12, 13% cash on cash returns that we were seeing initially are no more, right? So
Yeah.
that was all my net worth that would affect me. But it's only a portion. So, I try to live within the rules and guidelines that I have. And then the other thing that I think a lot of investors do is, they they don't control a portion of their own wealth, right? So when I sold half my California doors, there was also a portion that I knew, okay, I'm going to release control of my wealth here, allow somebody else to steward it. I'm going to diversify that risk. But at the same time, there's also a portion of my wealth that I want to make sure
Yeah.
I control fully. right? Where I have no partners, I own them. I have some with partners, I have some without partners, but there's a portion of your wealth that you also want to be able to control.
Yeah, that's great. And because you often hear, used as a marketing tool is like, oh, why operate actively when you could operate passively? And you almost see it as like a zero sum where people are making the full leap and abandoning the active ownership to strictly passive and aren't doing that diversification. So that's great. I'd love to dive into a couple things you had mentioned, right? You mentioned some lessons learned, some rules you have. Though that 10% net worth rule, was that created based on an experience, or did you go into that? Like, did you have a tough experience where like, hey, I'm not going this heavy again? Or is it like I'm going in here, my first investment was 10% and I'm never straying from that?
Yeah, I think it was mentorship initially, right? And then for me, I was also used to living and dying by my own sword.
Yeah.
So my first syndication in 2013 was oh sorry, I don't know if you heard that or not. But so I don't know if my first syndication was in 2013 and it was 100,000 initially, right? And then for me at that point, like it was the first time I was actually releasing control of my money. So there's some nerves around that. And then sitting with a mentor, he's like, look, Daniel, like if you're gonna allow somebody else to get revealed knowledge on your wealth with your own wealth, then you need to make sure you diversify that risk, right? Because there's a lot of like, and I remember he told me about Enron, right? The people that had
Hmm.
all their net worth in Enron and what happened. And it's like, look, you want to make sure that when you start allowing somebody else to steward your wealth, that there's not one operator that could take you down. And that just stuck with me because I'm like, I built my wealth and I built my business out of fear. Like I
Yeah.
was like, I'm like, every year I had a good year in sales. I thought that was the last year. I was
Yeah.
also in real estate. So, you know, I started in 2004, market was great. 2006, 7 and 8 crashed. Horrible market for 10 years as we were building up. We're buying assets, we're catching falling knives, basically assets that we're buying and they were worth less and less every year. So we're like, okay, we're just going to have to stay consistent with this. The first property that I bought was 300,000 and by the time 2011 came around it was worth 100 grand and I
Yeah.
still owned it. And I'm like, so all my experience was out of fear. So I'm like, and I remember he told me he's like the only reason people lose their assets is because they run out of capital to service. If there's a capital issue. It's not that your asset's not good. There's a capital issue, and and I stuck with that. And I remember when I was like, man, should I short sell my house that I bought when I was 22 because it's worth $200,000 less? And he's like, Daniel, do you have a capital issue? And your payment's 1,800. You're renting it out for 1,400. You're losing 400 a month. It's like your principal's going down 250. You're getting a tax write-off. You're actually net neutral. Um, Other than a line item on your balance sheet, you might save 200,000 on that balance sheet, but you're going to lose ability to be able to invest in other things, right? So those were the things that he kind of told me to say, well, so that also helped me served me well when I was looking at other operators to say, okay, well, what kind of liquidity do you have to be able to deal with some of the hard times that we're kind of seeing right now? And then what's funny is that property, fast forward today, it's worth
Hmm.
450,000 and 20 years later, it's almost paid off,
Yeah.
right? And the rent is no longer 15 or 1,400, it's 2,500, right?
Yeah.
So he was right. Like you give real estate enough time and it works. I think most operators are having a hard time because a lot of these loans are 5-year terms, right? The investment cycle is 5 years. So it's a different opinion, different advice when you're looking at a 5-year investment, 10-year investment, 15 investment, or 20-year investment. So that was what kind of helped me in regards to like diversifying, and then some of the lessons that I learned. Another thing that you mentioned as well in regards to some people think it's easy to just give somebody the funds and be completely passive. Well,
Yeah.
real estate is not passive; it's active now, but the LP positions, those are truly passive positions, right? Now you have an active operator. And one of the reasons why I tell people that I think it's always a good idea for you to start learning how to invest in real estate actively. So that way you're learning and getting those lessons. And I call them like Dan Sullivan calls them the 4 C's, right? And so it's number one, you have to commit, I'm going to buy this asset. Number two, you have to face and earn courage. So it means you need to face fear to courage, saying, okay, am I going to be able to do this? I'm going to release, say, 50,000 deposit or whatever down payment. And then, but once you face and earn that courage, you're going to find out what you're capable of. Am
Yeah.
I able to learn what lessons did I learn about this I thought was a great passive income. And all of a sudden I realized it was not as active and I wasn't making as much money. But then you learn what you're capable of, and then you learn what's my capacity there. For me, it was 80 California doors. That was my capacity. And at that point, I learned a lot of lessons as I earned my courage, earned my capability, and then earned my capacity. And so it's important for you to go through those 4 C's. And when you release control of your money and you're investing in other deals, you have to be very aware. Like I was aware that I was releasing my funds to them, and they were earning the knowledge, right? I wasn't facing fear. I wasn't earning my courage and buying, say, 100-unit property. They were, right? And so as I gave them my money, they were earning the courage, they were earning their capability and capacity. So as a passive investor, you have to understand that you are outsourcing the second and most important C, which is courage, right? You're partnering to outsource that, which is fine because you're allowing them to kind of build it, and maybe it's a great asset if you underwrite it properly. But you also have to be aware that if you start passive, you're always going to be that. You're never going to learn what it feels like to pull the trigger on a property, to renovate a property, to operate a property, to look at a balance sheet. And it's important for you to earn that skill set and not outsource that to somebody else all the time. And you see some investors that have started and always have done that, which is okay, but you just have to be aware that you're outsourcing your courage, your capability, and your capacity of being able to operate a property, even if it's a single family property yourself.
Yeah, I love that 4C concept, and it's really making me think of my origin story. And I've never really told the story, but when I bought my first 4 unit, I got smoked. I had spent a year doing property tours and doing due diligence on properties, and the day I bought it, 3 months later, I sent all my money. I mean, I sold my employee stock program, employee stock purchase plan to buy the property. I went all in on this thing. The day I closed on it, the insurance company emailed me and said I needed to replace the roof or they weren't going to insure me. And then 3 months later, COVID happened and no one was paying rent. And then one of my tenants was stealing from my other tenant. I couldn't fill a vacancy. So when you think about like that courage and that capacity, I put way too much trust in the wrong people when I bought it. And then the courage honestly it was almost over courage. You know what I mean? And so that had to get fixed. So that's fantastic. And now, so when you think about like your process, you mentioned one of the key questions you ask operators is about liquidity. Are there any like must asks when you're evaluating these operators?
Yeah, I think just especially some of the lessons that we're learning now, um, you know, is when things like any operator that's going bad right now, what are they doing? They're doing capital calls,
Yeah.
right? So let's start with the capital call. Everybody talks about how to get into a partnership. Nobody talks about how to get out of a partnership.
Yeah.
Let's talk about what it looks like if it's bad. Let's get that ironed out, right? And then, because it's easy and exciting getting into a new partnership, buying a new property. This is cool. The one thing I say is I'm like, man, numbers never lie, but I can make them say whatever I want,
Exactly. Yeah.
right? So all the numbers look great. A new business always exciting, but the questions and the magic is behind what happens if this thing doesn't go the right way. So that's where I would start to say, no, right, okay, you're expecting rents to go up a certain amount, or say, is there value add? So, okay, if there's value add, are you raising enough for the $500,000 or $1 million renovation, right? Are you investing enough to have the reserves to meet the vacancy factor as you're renovating these units, and maybe you have a 10, 15% vacancy, right? Are you going to delay? Some people want to pay a distribution right away. Well, maybe that's not the best route for that, right? Because you're like, if you're heavy lift on the investment and you're heavy lift on vacancy, and it's going to take you 2 years, I'd rather have an operator that says, look, we're not going to pay a distribution for 2 years. This is the plan for this property. This is what we're going to do. We have enough reserves to meet the vacancy, the debt service, and the renovations. Then I want to see that, and then say, okay, what if the numbers don't meet expectations? What does the debt look like? Is it a 5-year, right? What do you have as the new debt in year 6, 7, and 8? Do you have any extensions or not, right? Do you have any rate caps, or what are you doing on that end? And if you have any issues, what's your game plan on capital calls, right? Because like I said, a lot of the investors, even today, that are facing some issues and that might be losing their property, I guarantee you if they look 20 or 15 years from today, they're gonna be like, man, that was a good deal. I can't believe I lost that property, right? You see a lot of people right now that lost property during 2006, 7, and 8 that are looking at those properties saying, damn, I wish I would have kept that
Mm.
property, right? Um, so that's what I always want to look at, and know that a 5-year investment deal, it's heavy. If it's heavy lift and it's value add, you're probably not going to get distributions for a few years if it's done properly.
Yeah, that's fantastic. This episode of the Invest Clearly podcast is brought to you by Scale IR. If you're raising capital, you know the hardest part isn't just generating leads, it's turning those leads into committed investors. That's where Scale IR comes in. Scale IR transforms your investor engagement process with their proven solutions that optimize lead qualification, accelerate investor conversations, and drive higher conversions. From seamless CRM integration and intelligent workflows to expert investor qualification specialists who handle your initial discovery calls, Scale IR gives your team freedom to focus on closing deals. If you're ready to scale your investor relations and capital raising effectiveness, visit scaleir.com to learn more and book your strategy call today. Scale IR. Engage smarter, convert faster. And so, yeah, in our the pre-call room, you had mentioned some of the lessons that you had learned along the way, some of the losses you experienced, some of them quite large. Would you be open to sharing some of those stories in as much detail as you can?
Yeah, sure. I mean, I've it's no secret. I mean, I've lost over $2 million in bad operators, right? But I say it's never a bad investment. It's a bad operator, right? So the deals are always great. It's whether the plan is executed properly. Remember, like when you're releasing control of your money, you're giving the money to a jockey. Yeah, but is the jockey willing to die on the horse,
Mm-hmm.
right? Because a good horse, a good race, a good jockey is one that's willing to die on the horse. Like, are they willing to do what it takes to get this property going? And when I really look at all the properties or all the businesses or deals that I invested in that lost money, I would say almost 100% of them was an operator issue, right? It was an operator issue. They just didn't, and if you peel that back a little more, it comes in experience, right? So some of the operators now looking and knowing what I know now is they were going through those 4 Cs where they were committing to raise capital. This is going to be their property. They're going to buy 100 unit for 10 million. They're going to do their first renovation, which means they're facing fear, earning their courage to learn their capability and what they're capable of and what capacity. Like, am I capable to turn this property? So if I'm giving that money and you're facing that fear, even as yourself, you got to understand you might fail. That's why you're afraid, right? That's it. Sometimes you find out that you're not capable of doing this, so you didn't do it properly. And so what I found is I was giving my money to operators that were earning their courage with my money, right? And so now I look at it, I'm like, man, I should have gone to operators that had better reviews, better referrals, people that have seen life cycles, right? To seeing, okay, who's on your board, who's on your team, have they invested during the 2008, 9, 13, 14? If I had the investors that lost money are the ones that had an amazing property. They're like, hey, you find an amazing property, the money will come. And that's true, right? But you take an amazing property, you take the money in a bad operator and everything goes to shit, right?
Yeah.
And so they're not managing the project right. Timelines are missed. You got a 6-month or a year project that takes 3 years. They didn't negotiate the debt right. They didn't expect a certain expense when it comes down to the renovation or an economic vacancy or local laws and issues or neighborhood problems. So there's a lot of that I think you learn in the process. So when I really look at all mine, I'm like, man, my issues weren't the properties or the investment vehicle, it was the operator.
Yeah, for
Right?
sure.
It's like it was either the first time they got caught with, oh man, I didn't know that.
Yeah.
And they learned lessons on my money, and it cost them time. It cost me money.
Yeah, that's helpful. And we hear more and more of that narrative, the jockey and the horse. And I feel like it's shifting more from deal based over the last few years to now heavily towards sponsor operator based. So that's great to hear. So I'd like to pivot a little bit. You're a very unique guest in the fact that you host this Go Abundant 7 to 8 call, and you have such exposure to high net worth individuals that have made the leap from 7 figures to 8 figures. And a lot of our listeners are individuals who they do have that 7-figure net worth, obviously, because they are investing in this, but a lot of people are trying to shift into their investments being their primary source of income. What do you see based on those interviews from like even a mindset standpoint that separates the people that do invest their way from a 7-figure net worth to an 8-figure net worth?
Yeah, I mean, that's a good question. Um, Number one, I think they go deep, right? So I think, say for instance, you got a physician, right? A physician, and you have an ability to make $500,000 a year to $1 million a year, right? And that physician is saying, well, do I go in and start flipping property or buying property? And then you start realizing that they're getting out of their way, right? They're getting out of their lane. Um, it might cost them more than they expect, right? So somebody like that, I see, like even with me, right? If I look at my story, I was buying real estate, but I was in the space. But there was 10 years of my life that I'm like, I need to go deep in my business, generate more income. And instead of trying to figure out what how to make 10% of $500,000 or $1 million or $100,000. I'm like, what would it look like if I invested that money in myself and in my business, in my time, and then what would my revenue look like? So I think that's sometimes what you see with those stories is saying, look, what the best investment you can make is in yourself, going in your business. That physician might be better positioned, spending their time in their profession, right? And making 750, 800, 900,000 a year, right? If you can make an extra $200,000 a year, there's a lot of assets that you need to manage, or there's a lot of assets you need to be able to generate that kind of income. And then what you do with that income is what's important, right? So I think that's why when some professions, syndications are important, right? Because like, your skill set's pretty high. So I'm like, well, what's your exchange on time,
Yeah.
right? You want to get the knowledge, you want to be able to do a couple of them yourself. But then after you do that, you're like, okay, it's going to take me a long time for me to do this on my own. So I'd rather just go into my profession, earn a lot of income, be a steward of that income, invest in good operators, allow them and know that this is a cycle, right? You're going to do this for 5 years, maybe 10 years. But I'll tell you what, like the stuff that I came full cycle that were, I mean, I was averaging 30% IRRs, 35% IRRs. I mean, of course, it was also an up market. But even now, like some of these operators, 18 to 22% IR. So you got to think like, okay, if your goal is to invest $100,000 a year or $200,000 a year, like for me, it was every single year. We started with a couple hundred a year. At the last few years, we're investing $1 million a year in other deals. In my mind, I knew that this was going to come back in 5 to 10 years. If I invested $1 million this year, in 5 years, it's going to come back. I'm going to get 2.5 million back, right? Maybe 3 million back. And so I think there's also things that you do as you steward your business and you steward your time and you invest in other people's deals. Eventually that money's going to come back to you. Then you get to choose saying, okay, do I reinvest in that same operator, a different operator, or is it large enough for me to take control of this money myself? That's what happened to me. I'm like, well, my time is better suited in my business, but I know that if I do this consistently, faithfully for 10 years, when this money comes back, my business will be in a different position. I'll have more systems in place. I'll have a bit more time. And now if I invested, say, $2 million over 10 years, that's going to come back at 4 to 5 million, right?
Sure.
And now 4 to 5 million for me is that demands more of my time. Now it's okay. Now making 10, 15% on that would take my time, and now it should demand my time, and now it's worth my time. So I think for investors, you got to say, okay, where are you? And then a lot of it too, I think the secret behind my success was it wasn't just like 1 year I just invested in one deal and then like that's it. Like I was really consistent. Like I'm
Yeah.
like, no, I'm depositing every year. I was between 1 to 5 deals that I was putting money in. And then like I said, like up until the last year, I was putting well over 7 figures. So which I know that like I've been getting I've had capital events every year. Not these last 48 months, so one last year, but because it's not the right time. So the operators are keeping them a little longer. I think it's a smart idea. But I was talking to my accountant when we were getting all these capital events in 2018, 19, and 20. And I was redeploying. Some of them I was buying my own properties, and he was looking at my investments. He's like, Daniel, you're gonna have a big problem for a long time. He's like, because all the investments that you did in 2013, 14, 15, 16, they're all coming back at 18 to 22, 25% IRRs, 30% IRRs. So you've created a capital event windfall because I was so consistent for 10 years that now every year I have a capital event coming in. And if I was investing, say 10 years ago, and it's a capital event that came in 10 years ago, say 10 years ago in 2015, I invested 500,000, like I'm getting a million or $1.5 million in capital back this year, right? So then next year, if I invested in 2016, if I invested 700 or 600,000, I'm going to get another $1.5 million back, right?
Mhm.
So now it takes more active. So I think a lot of the issues that people have is they're just not consistent enough with a plan to create momentum and create this windfall of capital events, windfall of investments. And it's really hard because you're releasing control of your money, right?
Yeah.
And you're allowing somebody else to steward it. And like, okay, you're going to get some kind of distributions. Um, but like, I know that I didn't need the income to live on. And I needed, one of the quotes that I love is a person's wealth is measured by his ability to go without. Right. So then I'm like, delayed gratification. Like I was still making good money. Say you're a physician and you're still making good money, you're an attorney or you're an electrician, a contractor, you're making good money. Right. And so I want to be able to defer that with other things that are kind of coming in the future. Yeah, you're going to get some distributions. We make pretty good money with that. It's not like, it's great. It's good money, but the money is really made when you start seeing the windfall of capital events.
For sure. Awesome. That was fantastic. Okay, we are gearing towards the end of the call. I want to ask you the one question I ask on every call. It's my favorite question. What part of passive investing do you think needs to die?
Man, I think being part of a large organizations of guys, I realized that we fall into group think a lot,
Yeah.
right? Hey, I'm going to invest because I know this person that invested in. So I don't think us, and now with ChatGPT is really good because you could actually put these PPMs into ChatGPT and say, okay, pull these apart a little bit. But I think one thing that needs to die is groupthink. I think too many people have too much communicative knowledge. They're listening to a lot of different things, and they don't understand how to read a balance sheet.
Yeah.
They don't understand how to read, a performance report. I think that needs to die. I think, yeah, it's okay to be passive, but you also need to understand what you're reading. And then, so yeah, you're going to ask for referrals and you're going to call those referrals and you're going to ask questions. Right. And there was a lot of deals that I did that I'm like, I was group thinking like a mother, right? I'm like, that's a great operator. Boom. I'm going to put money in. This guy's smart. I'm just going to put money in this thing. And I'm like, man, I probably would have avoided some mistakes if I would have called and asked some questions.
Yeah. Yeah. Awesome. Awesome. Daniel, thank you so much for coming on. If people want to get a hold of you or learn more about GoBundance, where should they go?
Man, GoBundance.com, best way to start. It's an amazing organizations of guys living these amazing pillars of life. It's not about being a millionaire in your finances, but losing your soul, your health, your family, your adventure. Life is adventure. So this group of guys are focusing on being millionaires in all aspects of your life. And man, I'll tell you what, it's whenever you get around a good group of guys, it's hard to be stopped for sure.
Yeah.
So go to GoBundance.com. That's the best way to get hold of me.
Awesome. Daniel, thank you so much.
All right. See ya.
Right. Thanks for listening to the Invest Clearly podcast. To find verified investor reviews or to claim your GP profile, please visit investclearly.com. If you enjoyed this episode, please remember to like, subscribe, and leave a review because that's how other people find the show. Till next time, invest clearly.